Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, good. Evan, I want to talk about three things really. Davos, what happened there, inflation and interest rates, and tie it all together, if we can. It's a bit of a hard one.
We can do it. Davos is Davos. It's always interesting, but not much more than said. The other side of the talk was from the hedge fund managers, and they are clearly pointing to the fact that they are risk on. They were very, very strong, particularly equity hedge fund managers. We are risk on. We are basically, Ray Dalio, the one I love watching the most, he was very clear, and I said this last week, holding cash right now, you must basically be crying into your cereal, was his actual quote. And that makes sense because it's a growth. If we do have synchronized growth, risk is where it improves. And the other way to highlight that is have a look at what's happened in the last 6 weeks in Hong Kong. The Hang Seng has made record highs pretty much since then and is up almost 30% in the last 6 months and up 23% since December 17 or thereabouts. It's amazing, enormous, and that is like the growth, like the hub of growth. If you want to look at something, so Davos, and that's where it's at.
Yeah. All right. Well, let's move on to some other things now. So, inflation. We've got our own inflation data coming out. What are your expectations there?
Yeah, and we'll get to that. Other thing, the US inflation and European inflation has been, and it is also tomorrow as well for the European Union, and they're all tied into the story I'm about to talk about. So, our inflation is absolutely flatlining, and that needs to be put out there first. So we can talk about headline seasonally adjusted CPI. It has dipped into 2.1% at the high of last year, but it's come back out. You need to strip that out. That has things like energy and food and all that kind of material that is. So let's look at what the RBA looks at, because that gets back to your other part of your question around interest rates. The trimmed mean strips out all those outliers and looks at the core underlying inflation figure. Since 2015, so December 2015, it hasn't been inside the RBA's target band of 2 to 3%. For the last 3 consecutive quarters, it is flatlined at 1.8%. That's 20 basis points away from the very bottom of that band. Next point, the Statement of Monetary Policy in October, November last year, which is the RBA's forecast for outlooks of GDP and rah-rah-rah, its expectation of core inflation come June and December this year is 1.75%. So 5 basis points less than where it currently is, so close enough to where it is. It's not forecasting to hit 2% until December next year. Still not in that band. So
inflation low, we know it's low. What's the case then for interest rates?
Yeah, and this is, we'll talk about this. We'll talk about why the housing market is such a hotbed and hot speak about interest rates. Same with growth. But you've got to come back to the underlying theory around monetary policy. Pretty much every central bank in the world, barring the Fed, their number one and core only mandate is to maintain inflation. Now, every one of them has a different level or target band. Ours just happens to be 2 to 3%. Places like Europe, they have 2%. It's the same in Japan. If you look at the ECB, it's 1.5%. The Fed has the other mandate of employment, which is their dual mandate, so inflation at 2% and full employment, which they're meeting. They're not meeting the inflation one. So getting back to that point, how can you be thinking about raising rates when inflation isn't materializing? And not only that, if they were to raise rates when it hit, let's say it does hit 2%, that's the very bottom of the band. Inflation isn't tearing away. It's sitting at the bottom end of where they want it to be. So realistically, you'd need to see, in my view anyway, inflation probably about 2.25%, maybe even 2.5%, and moving in that direction to actually give the bank a mandate to say, yeah, things are starting to really move up. We're worried about probably overinflation or hyperinflation. We can start to hike rates. It's just not there. So that gets back to that rates question. Do I see rates movement? No, I don't. Do I see it in 2019? Maybe. But there are other sides to rates, and that's again, you've got to look at it is that the cash rate is what we all get sort of caught up on. It's not the only thing that affects your interest rate.
So let's talk about that now. We know that rates are rising overseas, and the US is on a clear mandate to increase rates. So what's that going to do for us here?
Yeah, and we're already starting to see it. So You're dead right. When we talk about interest rate rises at the RBA, most people believe that therefore will translate through into your interest rates in your term deposit on one side or on your home loan on the other. That is true. About 60% of our market, like our pool of funds to lend out from the banks, comes from term deposits or simple money market products, which is really good. It's why we're quite secure here, because our funding comes majority from our own people or from private lenders inside the bank. So you and I are going down there, getting a term deposit. It is good for term deposit holders because normally the bank prices a term deposit above the bank bill swap rate. So I don't know, maybe 100 basis points above. So if you're getting 1.5% at the moment, if you're really lucky, you might get 100 basis points up, which is 2.5%, give or take. But when they go on the other side, on the lending side, things like corporate loans, personal lending, and home loans, that pool is bigger than the pool on the term deposit side and the lending. So they need to go to the wholesale market. So this is where they go to the bond market, go to the corporate debt market, and that means going overseas. And this is where the US interest rates come into play and why you've seen out of cycle rate rises over the last 2 years from the big four banks and also all of the banks that are here in Australia, because they're borrowing overseas to fill that funding gap that they've currently got. We know that net interest margins have been under pressure from increasing wholesale funding, and that has been their justification. If you look what happened this week, the US 10-year government bond hit its highest level in 4 years, so 2.7%. So funding interest rates in the US are getting expensive. It's getting quite expensive. And therefore that impact comes through when there's refinancing the banks have to do and reissue capital. We've already heard this week that there's a probability that Westpac will do a new bond issuance. And the rate that they get there is, again, it's the US Fed target rate plus 50 or 100 basis points over. If you're at 2.7% on a 10-year, you're talking about 3.7% to borrow, let alone then having to give that to you and me onto our home loan. And it's in US dollars. Now, we're lucky at the moment the Aussie dollar is absolutely on a tear and at a 3-year high at 81 cents, but it won't be there for a huge period of time. That all builds up, and that builds pressure on the bank to move rates. So the talk around interest rates in Australia is a justifiable one, but the market naturally will probably actually impact it anyway by the wholesale market coming through in the housing market here.
Yeah, so there's definitely things to look to, especially if US rates overtake our rates, and then
which they will.
There's other dynamics.
Which they will, and that let's also be honest about that. Sometime this year, I am guaranteeing it. Put the hand up. I'm guaranteeing it. Sometime this year, the US will overtake Australia in interest rates for the first time in 19 years. The interesting thing about that, and getting back to what I just said about the Aussie dollar, the last time this happened, the Aussie dollar fell to below 50 US cents. So this is the next question: is that not only are you paying 2.5% plus, a margin, you've got to then double that repayment because the Aussie could be worth half, basically 50 US cents a pop. So it's a really interesting scenario that the back end of the year, so I'm thinking more sort of September, is probably the most likely time that we could start asking some really interesting questions.
Yes, lots to come this year.
Very much so.
Thanks very much, Evan.
Cheers, Tony.
Thanks for joining us on The Economic View.